Jake builds a portfolio of dividend stocks. Marcus buys a single S&P 500 index fund. They both invest the same amount every month for 30 years. Jake watches dividend checks hit his account every quarter and feels like he's already retired. Marcus watches a number go up on a screen and feels like he's doing nothing. Jake thinks he's winning, and on paper, it looks like he is. But is he really? Because the gap between what he thinks his passive income is earning him and what it's actually costing him every single year in taxes, in lost growth, in opportunities he never even saw, will make you rethink everything you've been told about dividend investing. And when you finally run the real math, one of these two strategies wins by a margin that isn't close. And it's probably not the one you'd guess. Let's keep this fair. Jake and Marcus are the same age, 30 years old. They both earn $75,000 a year. Same city, same tax bracket, same goal. Build wealth in a regular brokerage account and retire comfortably. The only difference is which strategy they choose. Jake builds a dividend stock portfolio. He spreads $1,000 a month across a mix of dividend aristocrats. Companies like Coca-Cola, Procter& Gamble, Johnson & Johnson, plus high-yield ETFs like SCHD and JEPI, and a couple of REITs to bump his yield higher. His average dividend yield comes out to about 4%. Every quarter, real money hits his account. He reinvests it automatically. It feels active. It feels strategic. It feels like he's building something tangible. Marcus opens the same kind of brokerage account and does something almost embarrassingly simple. He buys VOO, Vanguard's S&P 500 index fund, every month for $1,000. He doesn't research individual companies. He doesn't track yields. He just buys the entire US stock market and walks away. Jake's co-workers love hearing about his strategy. He talks about his passive income, shows them the dividend payments hitting his account, explains how he picked his holdings. Nobody at a barbecue has ever said, "Let me tell you about my index fund." It doesn't sound exciting. It doesn't feel like a power move. But feelings and math are two very different things. And what's about to happen over the next 30 years is going to expose every assumption Jake made. For the first few years, Jake looks like he's making the obviously smarter choice. By the end of year one, his portfolio is paying him about $480 in dividends. Year two, $1,000. Year three, $1,400. By year five, his portfolio is throwing off close to $2,800 a year. Every quarter, money lands in his account that he didn't have to work for. It feels like proof. Marcus? By year five, his VOO position has grown to roughly $73,000, but nothing is arriving. There's no quarterly check, no dividend notification, no cash flow event, just a number going up on a screen. Jake has stories. Marcus has a balance. On every visible scoreboard, Jake is winning. But here's what Jake doesn't see. Every single dividend payment he receives is taxable income. The year it's paid, whether he reinvests it or not. And his passive income isn't new money appearing out of nowhere. It's his own share value being handed back to him. Wall Street has known this for 60 years. Jake's YouTube feed has never mentioned it. The mirage is starting to form. He just doesn't see it yet. The dividend stock strategy is one of the most heavily marketed approaches in retail investing, and there's a reason. The cash flow feels incredible. But there's a difference between cash flow and wealth creation. The dividend strategy gives you the first one. It never promised you the second. Let's start with the concept that almost no dividend influencer ever explains. It's called dividend irrelevance. When a company pays a dividend, the share price drops by exactly that amount on the ex-dividend date. If a stock trades at $100 and pays a $2 dividend, the next morning it opens at $98. You didn't gain $2. You moved $2 from one column to another. You owe taxes on it. The share price went down by the same amount. That's not income. That's a forced partial sale of your own position. This isn't a controversial take. It's been settled finance theory since Miller and Modigliani published it in 1961. Your passive income feed just doesn't mention it. Then there's the annual tax drag. Every dividend Jake receives is taxable in the year it's paid. Even if he reinvests every penny, and he does, the IRS still takes a cut every April. Qualified dividends, the kind from holding U.S. companies for at least 60 days, get taxed at long-term capital gains rates, 0%, 15%, or 20% depending on income. That's the friendly version. Non-qualified dividends, which include most REITs and a lot of high-yield ETFs, get taxed as ordinary income, the same rate as a paycheck, all the way up to 37%. Jake holds REITs and JEPI for that juicy 7 to 8% yield. A meaningful chunk of his income is being taxed at his full income tax rate. And here's the brutal part of the math. Over 30 years, Jake's dividend tax drag costs him roughly 0.5% to 1% in annual return. That sounds tiny. It isn't. On a 30-year compounding window, a 1% drag turns into roughly $300,000 in lost wealth on the kind of contributions Jake is making. Not $30,000, not $50,000, $300,000. Then there's yield chasing. High dividend yields are often a symptom of distress, not strength. AT&T cut its dividend nearly in half in 2022 after years of being marketed as a safe dividend stock. General Electric, once one of the most reliable dividend payers in America, slashed its dividend from $1.24 a share annually down to a penny. Wells Fargo cut its dividend by 80% during 2020. Investors who chased those yields didn't just lose income, they lost capital, because dividend cuts almost always come with crashing share prices. Jake's strategy assumes the dividend is reliable. History says it isn't. There's also sector concentration. Dividend portfolios skew heavily toward financials, utilities, energy, and consumer staples. They systematically underweight the technology sector, the sector that has driven the majority of U.S. market returns over the last 20 years. Jake essentially opted out of the part of the market that's been compounding the fastest, and he didn't realize that's what he was doing. And finally, there's the behavioral trap. The dividend check feels like proof that the strategy is working, even when it isn't. Jake's portfolio could underperform the broader market by 1.5% a year for a decade, and Jake would still feel like he was winning, because dividends keep arriving. The cash flow becomes a psychological smokescreen. It hides underperformance from the only person who needed to see it. If I only showed you the downsides of dividend stocks, I'd be doing exactly what every dividend influencer accuses index investors of doing. Telling half the truth. Index funds have real limitations, and I'm going to lay them out honestly. There's no income stream. Marcus can't live off his portfolio without selling shares. For someone who values the psychological certainty of a dividend check, that's a real concession. Index funds are market cap weighted. That means a small handful of mega cap stocks, Apple, Microsoft, Nvidia, Amazon, Alphabet, make up a huge portion of the index. When that group corrects, the entire fund feels it. Marcus owns the broad market, but the broad market is more concentrated than people realize. You also own everything, including the losers, including overvalued companies in the middle of bubbles. The index doesn't filter for quality, it just owns whatever the market owns in proportion to size. Sequence of returns risk is real. If a major crash hits in the first 5 years of Marcus's retirement, selling shares to live on becomes brutal. Selling at a loss to fund expenses locks in damage that compounding can't fully undo. Dividend investors at least have an income stream that doesn't require selling. And there's the boring problem. Without dividends arriving, some investors panic sell during drawdowns because there's no cash flow to feel. The S&P 500 dropped 34% in 5 weeks during March 2020. The investors who held on were the ones with a system. The ones who just had a balance were the ones most likely to sell at the bottom. Index investing requires discipline that dividend investing partially manufactures for you. These are real costs. They aren't fake costs. But notice how the list compares to the dividend stock list. It's shorter. The items are more situational, and most of them are behavioral rather than mathematical. That's not me being unfair. That's the data being unfair to one side. For the first 5 years, the gap between Jake and Marcus is invisible. The divergence opens slowly, year after year, in a way Jake never sees on any single statement. By year 10, Jake's dividend portfolio has grown to about $185,000. Marcus's index fund is sitting at about $205,000, $20,000 gap. Jake's still receiving dividend checks, so it still feels like he's winning. The score on Jake's emotional scoreboard hasn't changed. The score on the actual math team, Jake is at $325,000. Marcus is at $380,000. The gap has grown to $55,000. Jake doesn't see this gap because he's not comparing his portfolio to Marcus's, he's comparing it to last year's version of his own, and that comparison still looks great. The dividend checks are bigger now. He's earning roughly $13,000 a year. It feels like the strategy is paying off harder every year. By year 20, Jake is at $510,000. Marcus is at $620,000. The gap is now $110,000. What happened? Three things, all small, all compounding. Number one, a roughly 1% annual return drag. Dividend-focused strategies historically return about 9% annualized over long periods. The S&P 500 has historically returned closer to 10%. That 1% gap doesn't feel like much in a single year. Over 20 years, it's the difference between $510,000 and $620,000. Number two, the tax drag. Jake has paid roughly $25,000 in dividend taxes by this point. That money came directly out of his compounding engine. Marcus has paid almost nothing. Index funds generate minimal taxable distributions because they don't actively trade. Number three, the expense ratio gap. Jake's dividend ETFs charge 0.06% to 0.35% in fees. Marcus's VOO charges 0.03%. That difference compounds too. Each cost looks small. None of them are dramatic in any single year, but three small leaks running for 240 months straight don't stay small. They compound into a number Jake never imagined possible and never saw coming because his account kept going up. That's the thing about dividend stock underperformance. It doesn't feel like losing. It feels like winning slightly less than you should be, and winning slightly less for 30 years is how people end up with a six-figure shortfall they can't explain. After 30 years of consistent investing, Jake and Marcus both retire at age 60. Marcus's index fund balance, approximately $1,780,000. Jake's dividend portfolio balance, approximately $1,410,000. That's a gap of roughly $370,000. $370,000. Jake never knew he was leaving on the table, because his statement always said his portfolio was going up and his dividend checks always confirmed his strategy was working. Cumulative federal taxes paid during the accumulation phase. Jake, roughly $48,000 across 30 years of dividend taxation. Marcus, roughly $3,000. That's a $45,000 swing. Money Jake handed to the IRS that Marcus kept compounding. But the gap isn't just about accumulation, it's about what happens at death. If Marcus dies holding his index fund and leaves it to his kids, they inherit it with what's called a step-up in basis. The cost basis resets to the value on the date of death. All those decades of capital gains, gone. Wiped clean. Marcus's heirs can sell the entire portfolio the next day and owe zero in federal capital gains tax. Jake's portfolio has been getting taxed every year of its life. There's no recovery for that. Same dollar amount inherited, dramatically different after-tax outcome. Jake didn't lose because dividends are inherently bad. Jake lost because three small leaks, return drag, tax drag, expense drag, ran simultaneously for 360 consecutive months. He never noticed any of them in any individual month. By month 360, they had cost him a fully paid off house. Here's where it gets interesting. Both Jake and Marcus are 65, retired, and need $50,000 a year to live on. Jake's dividend portfolio is throwing off roughly $56,000 a year in dividends. He doesn't have to sell a single share. The cash arrives in his account. It looks like he wins this round, at last. But Jake owes taxes on every dollar of those dividends the year they arrive, whether he wanted them taxed that year or not. Some are qualified, some aren't. After federal taxes, Jake takes home roughly $48,000 to $50,000 of his $56,000, depending on the qualified versus ordinary mix. Marcus has to sell shares to fund his $50,000 in living expenses. On the surface, this looks worse. He's depleting his portfolio. But here's what almost nobody talks about. Marcus has total control over when and how much he realizes in capital gains. Long-term capital gains brackets in 2026 work like this: 0% on gains up to roughly $48,350 for single filers, 15% up to roughly $533,400, 20% above that. Marcus has been holding his shares for 30 plus years, so most of the value is unrealized capital gains. When he sells $50,000 worth of shares, only a portion, let's say $40,000, is the actual capital gain. The rest is return of his original investment. By managing his withdrawals carefully, Marcus can keep his realized gains under that 0% bracket threshold. His federal tax bill on a $50,000 retirement income year? Close to zero. He's taking home essentially the full $50,000. Jake's tax bill on his $56,000 in dividends? Roughly $6,000 to $8,000 in federal taxes alone before state taxes. Same retirement lifestyle. Vastly different tax outcome. And that's before you account for the fact that Marcus has $370,000 more in principal still working for him, money that keeps compounding for as long as he lives. The dividend strategy that looked like the obvious income winner just lost the income comparison too. If I left the story here, I'd be telling the same one-sided story I accused dividend influencers of telling. There are situations where dividend stocks genuinely make sense. They're narrower than the YouTube algorithm suggests, but they're real. Inside a Roth IRA or 401k, the entire critique I just laid out collapses. The annual tax drag, the single biggest cost of dividend investing in a taxable account, disappears entirely. Dividends inside a Roth IRA are never taxed. If you want dividend exposure, this is where it belongs. Not in a taxable brokerage account. For retirees who genuinely value not having to sell shares, dividends provide psychological certainty that index funds can't replicate. There's real value in not having to make the "what should I sell this month" decision when you're 82 years old. It's not a math advantage, it's a behavioral advantage. But behavioral advantages are real. They're the reason most people fail at investing in the first place. If dividend checks are what kept you invested through the 2008 or 2020 crashes when you would have otherwise panic sold an index fund, then the behavioral edge of dividend investing might genuinely outweigh the mathematical disadvantage. The best strategy is the one you'll actually stick with. Dividend growth stocks specifically. Companies in the dividend aristocrats group that have raised dividends for 25 or more consecutive years have historically delivered solid returns at lower volatility than the broader market. As a complement to a core index position, they're a defensible allocation. The key word is complement, not replacement. Notice the pattern. Every single one of these wins is conditional, situational, or supplementary. None of them flip the math for the broad accumulator audience. They say use dividend stocks for these specific purposes in these specific accounts at these specific stages of life. Index funds win on tax efficiency in taxable accounts. The math isn't subtle. The annual drag from index fund distributions is roughly 0.05% to 0.15%. The annual drag from dividend stocks is 0.5% to 1%, 5 to 20 times less drag. Compounded over 30 years, that's the gap between Jake and Marcus. Index funds win on diversification. One fund, hundreds or thousands of companies, automatically rebalanced as the market changes. No research, no monitoring, no decisions about whether to add or trim individual positions. Index funds win on cost. VOO charges 0.03% in fees. Many dividend ETFs charge 0.06% to 0.35%. And active dividend mutual funds charge even more. That gap looks small in any given year. Over 30 years, on a $400,000 portfolio, the difference is real money. Index funds win on control. Marcus chooses when to realize gains. Jake's dividends arrive whether he wants them or not. In retirement, that control is worth thousands a year in tax savings. Index funds win on estate planning. The step up in basis at death is one of the largest legal tax advantages in the U.S. tax code. Index fund investors capture it fully. Dividend investors paid taxes every year of their life and get no equivalent recovery. And index funds win on the historical record. According to S&P's SBIVA reports, roughly 90% of actively managed strategies underperform their benchmark index over 15-year periods. Dividend-focused strategies are no exception. The data is settled. The investing industry just doesn't want to talk about it because there's no money in selling people the boring answer. Jake walked into his strategy thinking he was making the smart play. Dividend checks every quarter, real income, tangible proof the system was working. He wasn't being foolish, he was responding to the same marketing every retail investor sees. Marcus walked into his strategy thinking the simple answer was probably the right one. Most of the time, when it comes to long-term investing, it is. Here's what actually works for most people, and it isn't picking a side in this debate. Step 1. Build your core wealth in low-cost index funds during your accumulation years, VOO, VTI, or a total market equivalent. This is where the math wins. Full stop. Lower taxes, lower fees, broader diversification, higher historical returns, and total control over when you realize gains. Boring, effective, tax efficient. Step 2. If you want dividend exposure, hold it inside tax-advantaged accounts. A Roth IRA is the perfect home for dividend stocks. The tax drag disappears entirely, and you keep the cash flow psychology if that's something you value. Putting dividend stocks in a taxable brokerage account when you have Roth IRA space available is one of the most expensive mistakes a retail investor can make. Step 3. As you approach retirement, within 5 to 10 years of pulling the trigger, you can shift a portion of your portfolio toward dividend growth stocks for income stability. But as a complement to your index core, not a replacement. You're not abandoning the strategy that built your wealth, you're adjusting the cash flow structure for a different stage of life. The real trap isn't dividend stocks. The trap is being told that passive income is the goal when total return is the actual goal. Dividends aren't free money. They never were. Every dollar of dividend income you collected this year cost you something. In taxes, in lost growth, in compounding you'll never get back. The dividend was never new money. It was your own share value being handed to you, with a tax bill attached. For most people, most of the time, building wealth in a taxable account with a 20-plus year horizon. Index funds win. Not by a little. By a lot. And if you're wondering how either of these strategies stacks up against just buying a single growth stock and holding it for 30 years, that's a completely different conversation. And the math might surprise you.